Hello and welcome to ACCA Masters. Today we'll be covering Chapter 22 of F3, Consolidated Statement of Profit and Loss. We have already covered Consolidated Statement of Financial Position in Chapter 21. In this chapter, we'll focus on how you can consolidate the statement of profit and loss of a parent and its subsidiary. To revise the concept very quickly, as we discussed in Chapter 21, a parent is an investor that has control of another company. A parent company has control of its subsidiary company, and that is usually because the parent company has purchased more than 50% shares, 50% or more shares of the subsidiary company. In such a scenario, you have to perform consolidation, where you have a parent, an entity that has control over another entity, a company that has control over another company, and then you have a subsidiary, which is the entity being controlled by the parent. Control here it defines the power to govern the financial and operating policies of an entity so as to obtain benefits from its activities. Another way of saying, as discussed in Chapter 21, you have full control of the decision making of the subsidiary company. As a parent, you can decide to do whatever you want when it comes to the financial and operational decisions of the subsidiary. Now, the financial statements of a parent and its subsidiary are presented together. That is what we mean by consolidation. You have to take the statement of profit and loss of the parent and you have to mix it with the statement of profit and loss of the subsidiary. You have to put together the values and present the values as if they are the values of one company. So for the parent and for the subsidiary, you have to collectively present one statement of profit and loss. The revenue included in this statement will be the sum of the revenues of the parent and the subsidiary, and the same goes for expenses as well. The expenses included in the consolidated statement of profit and loss will again be the sum of expenses of both parent and subsidiary. Right? We did a similar thing for the statement of financial position as well, for the assets section and the liability section. For equity, it was slightly different. We did not add the values of parent and subsidiary for the equity section, but for the asset section and the liability section, you may remember, we added the values of parents' assets and the subsidiaries' assets, and then for the liability section, we added the values of parents' liabilities with subsidiaries' liabilities. We'll do a similar thing here with the statement of profit and loss, where we'll take the revenue of the parent and add it with the revenue of the subsidiary, and then we'll take the expenses of the parent and we'll add them with the expenses of the subsidiary. IFRS 10, to remind you, is the main accounting standard that covers the preparation of consolidated financial statements. So here we have a simple scenario. When I say simple, I mean there are no adjustments yet required in this scenario. We will cover a couple of adjustments later in this chapter that you need to be familiar with, that you may have to make while preparing the statement of profit and loss of two companies, preparing the consolidated statement of profit and loss. So the statement of profit and loss for PNS, parent and subsidiary, for the year ended 31st August is shown below. P acquired 75% of the ordinary share capital of S a few years ago. So we have the individual statement of profit and loss here of the parent. We have the individual statement of profit and loss of the subsidiary. And now we have to prepare the consolidated statement of profit and loss for the year. Now, it will be a simple addition in this case because they have not informed us of any necessary adjustments. Um, so in this case, to prepare the consolidated statement of profit and loss, we will simply start with adding up all the values. So first of all, we have revenue. The formats obviously of a consolidated statement of profit and loss and a simple statement of profit and loss, a single company statement of profit and loss is the same. So we start with revenue And for the revenue, we will take the revenue amount of the parent, 1200, and add it with the revenue amount of the subsidiary, 400. So 1200 plus 400 gives us the revenue amount for the consolidated statement of profit and loss. We'll do a similar thing for cost of sales. We have the cost of sales amount of parent, 1080, and then we have the cost of sales amount of subsidiary, 360. We add them up, 1080 plus 360, and we get the cost of sales amount for the consolidated statement of profit and loss. Now for the gross profit calculation, you don't have to add up the gross profit amounts. Instead, you already have the revenue amount here in the consolidated statement of profit and loss. You also have the cost of sales amount. You will take their difference and calculate the gross profit amount. So for the gross profit amount, you don't need to add the gross profit amounts of the parent and subsidiary. Instead, you have to calculate the gross profit amount. You'll do a similar thing for all the values that you have to calculate within the statement by adding or subtracting. So, for example, next we have administrative expenses. For administrative expenses, we take the value of parent, add it with the subsidiaries administrative expenses. We get the administrative expenses for the company, for the consolidated statement, for the group. And now for the profit before tax amount, we calculate the profit before tax amount by taking the difference between gross profit and our operating expenses, in this case, our administrative expenses. So we'll simply subtract the administrative expenses we have here in the consolidated statement of profit and loss from the gross profit amount. You don't need to add the profit before tax amount from the individual statements. Instead, you should, and this is how you should always do it, you should take the difference between the gross profit amount and the operating expenses amount to calculate your profit before tax or profit before interest and tax. So any amounts that are calculated within the statement should also be calculated in the consolidated statement of profit and loss. And any amounts that are just presented in the statement, like revenue, cost of sales, administrative expenses, the tax amount, these you can add up from the individual statements and then get the value for the statement of profit and loss, consolidated statement of profit and loss. So we have then the tax amount. The tax amount will again be 15 for parents, 6 for subsidiary. We add them up and we get our tax amount to be included in the consolidated statement of profit and loss. And then for the profit for the year, we have to take the difference between profit before tax and tax amount. 55 minus 21 gives us 34 as profit for the year. Now, once you're done with the consolidated statement of profit and loss, you have to put a little section at the end of the statement to show the share of profit as divided between the parent and the subsidiary. For this, you have to go for the individual profit of the subsidiary. Remember, the profit of the parent is not being divided between the parent and the NCI. It's only the profit of the subsidiary now that has to be divided between the parent. 75% has been acquired by the parent of subsidiary company. So 75% of subsidiary's profit is supposed to go to the parent, and the other 25% is supposed to go to NCI, to the non-controlling interest investors. So this is only to be done for the subsidiary's profit, not for the parent's profit. Parent's profit belongs in its entirety to the parent company. It's only the subsidiary profit that has to be divided between the parent and the non-controlling interest investors. So you take the individual profit of the subsidiary from subsidiary's individual statement, and to that you apply the percentage of non-controlling interest. The non-controlling interest percentage here can be found by subtracting parents' ownership percentage, which is 75%. So 100% minus 75% gives us NCI's percentage of ownership, which will then be 25%. So you can calculate NCI's share of subsidiary's profit, 25% of this 4,000. So you apply 25% to 4,000 and you get NCI's share of subsidiary's profit, that is 1,000. And that you can show as being NCI's share of this overall profit. NCI's share of this overall profit is 1. The total profit we know is 34, so the remaining profit belongs to the parent, or as it's mentioned here, the group, that is 33. So this is the balancing figure, which means that we have found this by subtracting NCI's share of the profit from the total profit amount. And this is how you complete the consolidated statement of profit and loss. Like I said, this is a basic consolidated statement of profit and loss. Um, Now we'll be covering some adjustments that you may have to make in the consolidated statement of profit and loss. Mainly, these adjustments will come from the intra-group trading, intra-group transactions. Intra-group trading are transactions that take place between the parent and subsidiary after acquisition. Now, the adjustment required here is first of all the intra-group trading that has to be eliminated from the sales amount and the purchases amount. If parent and subsidiary are selling goods to each other, if parent is selling to subsidiary or subsidiary is selling to parent, those sales and purchases amounts will be included in the revenue and the cost of sales amounts of the parent and the subsidiary, or the subsidiary and the parent. Right? That doesn't really matter who is the seller in this case, um, because we're mainly concerned with finding the total amount of sales made by parent to subsidiary or by subsidiary to parent, right? We need to find the total amount of sales made between these companies, and then we need to subtract that amount both from the sales amount, from the revenue amount in the consolidated statement of profit and loss, and we also need to subtract it from the purchases amount from the consolidated statement of profit and loss. Because if parent is selling to subsidiary, right, then the amount of transaction will be included in the revenue amount of the parent. And because subsidiary is purchasing those goods here, so it will also be included in the purchases amount of subsidiary. So that is why this amount of transaction between parent and subsidiary has to be subtracted from both revenue and purchases. Similarly, if subsidiary is selling goods to the parent, then in the revenue amount of the subsidiary, you will have this amount of transaction that has taken place, the value of goods that have been sold to parent. And in parent's purchases amount, you will have the same value of goods recorded, the same purchases amount expense recorded. And therefore, you have to find out this amount of transaction, total amount of transaction, total value of goods that have been sold between the parent and subsidiary, and you have to subtract this amount, these value of goods, both from the purchases expense as recorded in the statement of profit and loss, consolidated statement of profit and loss, and you also have to subtract this amount from the revenue calculation for the consolidated statement of profit and loss. We also have to adjust for the unrealized profit amount. We have already looked at this. The unrealized profit amount has to be calculated. The remaining unrealized profit amount at the end of the year has to be calculated and then subtracted from your closing inventory amount, right? Now, closing inventory, you may remember, is the only item that gets included in both the statement of profit and loss in the cost of sales section. Closing inventory is subtracted, and then closing inventory is also included in the statement of financial position as a current asset. So this is why this adjustment that we looked at of removing unrealized profit from closing inventory, subtracting the unrealized profit amount from closing inventory, This adjustment has to be made both in the statement of financial position and current assets where we're presenting closing inventory, and it also has to be made in the statement of profit and loss in the cost of sales section. From the closing inventory amount we will subtract the unrealized profit amount. So basically, in the cost of sales calculation, this is a typical cost of sales calculation, we have to subtract the remaining unrealized profit amount at the end of the year from the closing inventory value. So let's say the uh, remaining unrealized profit here that we have to subtract from the inventory amount here, unrealized profit. Let's say that is 2 in this case, right? These are values in thousands or 2000. So we basically have to subtract this. Okay, it's not 2, it's 7. Excuse that, means we have the unrealized profit amount as 7. So we have to subtract this 7 from closing inventory, right? So if we subtract this 7 from closing inventory, look at how the values change. Now the opening inventory stays the same, right? Remains 10. Purchases remain the same, but closing inventory now becomes 2 because we have subtracted the unrealized profit amount from our closing inventory. Now, as a result of closing inventory decreasing, see what happens to cost of sales. You may be able to imagine what will happen to cost of sales here. Because closing inventory is subtracted in the cost of sales calculation, the cost of sales will increase if closing inventory decreases. From here to here in the unrealized profit adjustment, closing inventory has decreased. And when closing inventory decreases, because it is subtracted in the cost of sales calculation, cost of sales will increase as a result of this, right? Because they have an inverse relationship. So you have to remember this because oftentimes in these statements of profit and loss, they will not give you the full cost of sales calculation. They will only give you the cost of sales amount as we looked at earlier in a statement. We did not have the full amounts of opening inventory, purchases, and closing inventory. We only had the cost of sales amount given. So you will have to adjust this remaining unrealized profit directly in the cost of sales amount. So you have to remember that when you have to subtract the remaining unrealized profit from the closing inventory value, but the closing inventory value is not given, we have the cost of sales given directly. The way to adjust this remaining unrealized profit is to add it in the cost of sales amount. And that has the same effect, that gives us the same cost of sales that we were getting if we were to subtract this unrealized profit from the closing inventory value. So you will have to adjust the unrealized profit directly in the cost of sales amount. You will not be able to subtract it from the closing inventory value. So you have to remember that if you were to subtract it from the closing inventory value, it will basically mean adding it in the cost of sales amount. So that is the adjustment you have to make. You have to add this unrealized profit in your cost of sales amount. That is the same effect as we will get if we were to subtract this unrealized profit from the closing inventory value, which is included in the cost of sales calculation. Right. So this is the adjustment that you have to make and you have to remember for the cost of sales value in this consolidated statement of profit and loss. So here we have a scenario during the year ended 31st December 2019. Parent had sold $42,000 worth of goods to us. These goods had cost 28,000. So we can calculate the unrealized profit on this. Um, on 31st December, S still had half of these goods in inventory at the end of the year. So originally, when the goods were sold by the parent to subsidiary, the unrealized profit on this would have been 14,000. 42,000, the sales value of the goods, minus the cost of the goods. So unrealized profit on these sales made by parent to subsidiary would have been 14,000. Now they're telling us that half of these goods remain in inventory at the end of the year. Now you may remember, as we discussed in chapter 21, if you sell some of the goods, that means you have realized profit on it. You have benefited from those goods already. So you don't need to account for the unrealized profit on those goods, since that profit has technically now been realized with the goods being sold to a third party, to a customer. So you only have to account for the unrealized profit on goods that still remain in inventory. Now they're telling us that half of these goods still remain in inventory at the year end. So we will take half of the unrealized profit amount. So half of 14 is 7. And that is our remaining unrealized profit that we now have to adjust in our closing inventory value. We also have the sales amount here of 42,000. Remember, we have to adjust this value in the sales and the purchases amount, in the revenue and the cost of sales amount as well. So this is what the adjustments will look like. First of all, in the group revenue calculation, you will take the revenue of the parent, you will take the revenue of the subsidiary. So add these two up, 630 plus 260, and you will subtract this sales amount of 42, that is basically sales made by parent to subsidiary, from this calculation to get the revenue amount to be included in the consolidated statement of profit and loss. Again, because sales have been made by parent to subsidiary here, that is not logical for the consolidated statement. The consolidated statement assumes that parent and subsidiary are one company. So any sales made by parent to subsidiary are are like selling to your own self, which is not a real sale, which is not real income. And that is why we're subtracting this sales amount from the total revenue amount to be included in the statement of consolidated statement of profit and loss. We also have the cost of sales amount. Now remember, we also have to subtract this 42,000 from the purchases amount, because subsidiary has purchased these goods here, and these will be included in the purchases value of subsidiary, included in the cost of sales calculation. So we have to subtract this 42,000 from the cost of sales calculation. Basically, that is a way of subtracting this 42,000 from the purchases amount of subsidiary. So for the cost of sales calculation, we will start with the cost of sales of parent, 210. We'll add the cost of sales of subsidiary, that is 105. And from that, we will subtract the 42,000, the total value of sales made by parent to subsidiary, so as to subtract this from the purchases amount of the subsidiary, right? We also have to add the unrealized profit amount of 7,000 in the cost of sales amount, as discussed earlier. Any unrealized profit amount has to be subtracted from the closing inventory value, but we don't have the closing inventory value here. What we do have is the cost of sales value, and we know that closing inventory has been included in the calculation of cost of sales. So the way to subtract this unrealized profit of 7,000 from the closing inventory value is to add it in the cost of sales value. So these are all the adjustments that you have to be familiar with when it comes to the revenue and cost of sales amount in the consolidated statement of profit and loss. Right. Um, how do you account for this adjustment in NCI's share of profit? Now, let's say, for example, you have subsidiaries profit after tax here of 200,000, and NCI is supposed to get 10% of that. So you calculate NCI's share of post acquisition profit. Right. 200,000 times 10 gives us NCI's share of profit for the year, that is 20,000. Now, this is the NCI share of profit that we have to show at the end of statement of profit and loss in the attributable section, right? Because we have to show how much profit is going to the parent, to the group, and how much profit is going to NCI. So to calculate NCI's share of this profit for the year that we would have calculated up here, we have to, right, this is in this case 200,000. So we have to, well, it's not 200,000 actually, that. will probably be higher because, as you may remember, we have to take subsidiaries individual profit, right? So in this case, for example, we will take subsidiaries individual profit amount of 67,000 and we will apply any NCI percentage to only subsidiaries profit. Parents profit is not supposed to be divided between parent and NCI. Only subsidiaries profit is to be divided, and therefore we will take subsidiaries profit amount from their individual statement, right? So that in this case is 200,000. Will apply. This is a different example. This is not a continuation of the previous example. So we assume that subsidiaries individual profit is 200,000. We apply NCI's percentage to that, and we get NCI's share of subsidiaries profit, that is 20,000. Now we also have to adjust in this um, NCI's share of unrealized profit. If subsidiary is the seller, if subsidiary is the seller, then we have to, only in that case, we have to subtract from here NCI's share of unrealized profit. So we take the unrealized profit amount, let's say it's 1000. We apply NCI's percentage to that. This should be 10%, not 20%. And therefore, we should have here 100. The value has been, the percentage has been taken incorrectly, but the point is we have to include, we have to subtract NCI share of unrealized profit from this calculation of NCI's share of profit for the year. So we take subsidiaries individual profit amount, we apply NCI's percentage to that, and we get NCI share of subsidiaries profit. That is 20,000. And then this is not the final amount that we will attribute here to NCI. First, we have to adjust in this the NCI share of unrealized profit. And for that, we will take NCI, we will take the unrealized profit amount. We will apply NCI's percentage to that, 10%, and that will give us the unrealized profit amount. And we will then subtract this unrealized profit amount, because remember, unrealized profit amount increases your cost of sales. So the effect on profit will be a decrease in the profit amount due to unrealized profit. So we will subtract the unrealized profit amount from 20,000 here, and that will give us NCI's share of unrealized profit. Sorry, NCI's share of profit for the year. And this is what we will show in the attributable section in the statement of consolidated statement of profit and loss. Right. So a little extra adjustment you'll have to make in the calculation of NCI's share of profit for the year. Uh, so do try this out. This will come up in the kit questions as well. More frequently tested adjustments are the ones we've covered previously. So do focus on those. Make sure you understand them conceptually. Obviously, if you have any follow-up questions, do let us know. So here we have another type of adjustment that you may come across. Now, in this case, you can see that they have given us the statements for the year ended 31st March 2019. So we have to prepare the consolidated statement of profit and loss for the year ended 31st March 2019. Now, the company was acquired on 30th November 2018. Now, if you count the number of months it has been since acquisition, they add up to December, January, February, March, 4 months. So now that we're preparing the consolidated statement on 31st March 2019, it has only been 4 months since the acquisition of subsidiary. So what we have to do is, the thing is, some of these revenue amounts and cost of sales amount, they belong to before the subsidiary was acquired, and consolidation only has to take place for the values after subsidiary has been acquired. So this revenue amount, this is a full year's revenue amount, right? This revenue amount is for the period of 1st April 2018 to 31st March 2019. Acquisition took place on 30th November 2018. So, in the consolidated statement of profit and loss, we only include subsidiaries revenue that was made after acquisition, that was made during December, January, February, March. Now, they're telling us that the profits of both entities are deemed to accrue evenly over the year. They will give you this statement. This basically means that you can assume that this profit, this revenue amount, the cost amount, the expenses amount, they can be divided evenly over the 12 months that they belong to. So you can assume that the monthly amount of revenue is the same for all 12 months. This yearly amount can be divided equally over 12 months. The cost of sales amount can be divided equally over 12 months. So what you have to do in this case is you have to prorate subsidiaries data when preparing the consolidated statement of profit and loss. So the consolidation will look something like this. For the parent, they were always part of the group. They were always there. So you will take full amounts for the parents' values, right? Full amount of operating expense of 35,600, full amount of investment income of 1400. So for the parent you will take full amounts, but for the subsidiary you will take their, for example, revenue amount 108,850, and you will prorate it to find the amount for 4 months only, the number of months it has been since acquisition. So far we have looked at examples where the acquisition took place at least 1 year ago or even before that, so we did not have to prorate the values, we could just add them up directly. But in this case, it has only been 4 months since acquisition. So only for subsidiaries values, you will take the total value and then prorate it to find the amount for the number of months it has been since acquisition. So for operating expenses of 25650, we will multiply it with 4 over 12 since it has been 4 months since acquisition, and that will give us the operating expense amount to be added with parents' operating expense amount. So we will prorate all the values of the subsidiary like this. Remember, we don't have to prorate parents' values, only subsidiaries' values have to be prorated. And even in the calculation of NCI's uh, uh, share of the profit for the year, we will again take the NCI's, we will take subsidiaries individual profit 16,400. We will again prorate it 4 over 12, and then we will apply the NCI's percentage to that to get your NCI share of profit for the year. So remember, you may have to prorate the values of subsidiary in some scenarios if it has not been more than 12 months since the acquisition took place. It has been, if it has been 12 months, if it has been 1 year or more than 1 year since the acquisition took place, then you don't have to prorate the values like this. You can just add them up as we have done so far. But if the acquisition took place less than 12 months ago, then you have to prorate subsidiaries values for the number of months that it has been since acquisition. And lastly, we have the concept of accounting for investments in associates, right? We don't have to cover joint ventures. IAS 28 is the accounting standard that tells you how to record investments in associates in your accounts. It also covers the recording of joint ventures, although that is not part of the syllabus in F3. So we only have to cover the investments in associates and how they are to be recorded in your statement of in your financial statements. Now, if you're investing in a company and you only have significant influence over that company, an associate is defined as an entity over which investor has significant influence. So in terms of ownership percentage, that is between 20% or 49% of the investee company. Significant influence is the power to participate in the financial and operating policy decisions of the investee, but is not control or joint control over those policies. Right? So, significant influence is the power to participate in the decision making, but it is not unanimous control that you have over the decision making of the associate company. Now, in this case, investment in associate is shown much like a simple investment. It is shown as a non-current asset because it is an investment in the statement of financial position. So the investor will show investment in associate as a non-current asset in the statement of financial position. And every year you will calculate your share, parent share, investor's share of associates profit for the year. So if you have invested 20% in a company, you will take 20% of that company's profit for the year and add it in your investment value. Parent share of any unrealized profit. So your asset value, your investment in associates value will increase every year by your share of associates profit for the year. Parent share of any unrealized profit from trading with associate is also deducted in the group retained earnings and from the investment value. So if you make any sales to the associate, or more importantly if associate makes any sales to you, in that case you will have unrealized profit, and therefore your share of unrealized profit, if you have 20% 30% ownership of the associate, your share of the unrealized profit will be subtracted from group retained earnings calculation, and it will also be subtracted from the investment in associates value that you're presenting in the statement of financial position. Now, if investment in associate is impaired, which can happen, the associate may lose some of its value if it's not as popular or successful anymore. The impairment should be deducted from investment value and from group retained earnings. So, if you find any impairment given for your investment in associates, you should subtract that again from the investment value that you're presenting in non-current assets in the statement of financial position, and you should also um, subtract this from your group retained earnings, since technically it is a loss on investment for you. So that is how you record an associate in your statement of financial position and statement of profit and loss. Um, that covers the overall recording of subsidiaries and associates in your financial statements and the preparation of consolidated financial statements. Make sure that you cover this a number of times because it is an entirely new concept. Do try this home assignment as well. From Kaplan Kit questions 449 to 485. Let us know if you face any issues with them or if you have any follow-up questions regarding the current chapter. If you're able to understand the concept of consolidation, and if you're able to comprehend the workings, the five workings that we've looked at in chapter 21, and these adjustments that we've looked at in chapter 22, consolidation questions should be pretty basic at F3 level. So make sure that you will attempt them a number of times so you're well familiar with the concept and with the workings of consolidation. Again, to write the home assignment as well, and let us know if you have any issues with this or if you have any follow-up questions regarding these chapters. Uh, Good luck with the preparation. Again, let us know if you face any issues. Take care. Bye bye.